Welcome to the deep dive. Today, we're digging into a world that's literally about digging, but we're focusing on the financial side. How mining companies handle the complex reporting requirements under IFRS. We've got a really solid source document guiding us today, primarily a deep dive publication from PwC. It walks through the entire life cycle of a mine and the unique accounting challenges that pop up at each stage under IFRS standards.
That's exactly right. IFRS is designed to be, a principles-based framework applicable across all industries. But when you apply something broad like that to an industry as specific, risky, and capital-intensive as mining, you encounter some truly fascinating complexities. Our mission really is to take this material and help you understand the most critical issues and the judgments companies have to make.
Think of it as getting a clear view of the financial bedrock beneath a mountain of technical detail. Okay, let's unpack this.
So the first thing to understand is that mining isn't just one single activity. It's a distinct value chain that progresses through very different phases. Finding the deposit, that's exploration and evaluation.
Right.
Then setting up the operation, development. Extracting and selling the ore, which is production. And finally, closing the site down, closure and rehabilitation. Each of these stages has its own set of significant accounting questions.
And it's not like manufacturing cars or selling software, is it? You're dealing with assets that are hidden underground, require enormous upfront capital with often no guarantee of success.
Exactly.
And you have significant environmental obligations built into the process from the start. These unique characteristics are why applying IFRS here gets so challenging. It all kicks off with exploration and evaluation, right? Trying to find something valuable. The source highlights the difference between a mineral resource and a reserve. Why is that distinction so important in the accounting world?
Well, because reserves are the part of a resource that you've determined is economically mineable.
Economically mineable, okay.
Yeah, this means you believe you can actually get it out of the ground and sell it profitably. Resources are broader. You know it's there, but you haven't yet proven it's economic. This distinction is absolutely critical because reserve and resource estimates are inherently based on a ton of assumptions and estimates. Geology, engineering, future commodity prices, you name it. They're a key indicator investors look at when evaluating a mining company, even though the detailed reserve reports themselves often sit outside the formal audited financial statements.
Right.
Unless local regulators specifically require them to be part of the audited filing.
That makes sense. You're relying on future expectations, not just past costs. So how do companies account for the costs they rack up during this high-risk exploration phase?
This is where IFRS 6 comes in, and it offers some interesting flexibility. Unlike most assets under IFRS, where you need to demonstrate a probable future economic benefit to capitalize costs, IFRS 6 gives companies a choice.
A choice.
Yes, they can either expense these E&E costs as they occur, or they can capitalize them. This standard essentially provides a temporary shelter, sort of. It allows you to keep capitalizing costs associated with searching for and evaluating a potential deposit, even if you haven't fully proven its viability under the general IFRS definition of an asset yet.
Okay.
It reflects the reality, you spend money before you know if you'll find something viable.
Right. The source gives an example of entity A transitioning to IFRS, potentially using this IFRS 6 flexibility. So management has this initial choice then.
Yes, management decides the accounting policy expense, or capitalize, and applies it consistently. But, and this is important, if they choose to capitalize, those capitalized costs aren't just forgotten. They must be tested for impairment if there are any signs that deposit might not be recoverable.
Impairment, okay.
And this testing needs to be done on a mine-by-mine basis.
What happens if they've got a project on the books, capitalized costs, and then after the balance sheet date, they discover it's actually unsuccessful? Maybe they decide to walk away.
That brings in IAS 10, which deals with events after the reporting period. The key question is whether that failure is an event that relates to conditions that existed at the balance sheet date.
An adjusting event.
Exactly, an adjusting event. Or if it's a new condition that arose after the period end.
A non-adjusting event.
Right. So if the geological data or economic conditions already present by the balance sheet date suggested the project was failing, it's adjusting, and they'd need to impair the asset as of the balance sheet date.
Okay.
But if the decision to, say, relinquish the property was made after the period based on new information or conditions that changed post-balance sheet date, it's non-adjusting. You disclose it,
Yeah.
but you don't change the prior period's numbers.
It shows how quickly the value can change.
Definitely.
And the source points out that regardless of capitalization choice, companies need to disclose their accounting policy for E&E, and the amounts recognized expensed costs hit operating cash flow, capitalized costs are investing.
Exactly. Clear disclosure helps users understand the company's approach to this risky stage. So once the technical feasibility and commercial viability are confirmed, often backed by a comprehensive feasibility study, they move into the development phase.
Right, the construction phase.
Yeah, this is where the real building begins.
Yeah.
And that decision point between evaluation and development is a major accounting hurdle
Why is that?
because it dictates when those massive capital costs start getting capitalized as part of the mine asset.
And massive is the key word there. Developing a mine is incredibly capital intensive. How do they account for the borrowing costs associated with funding all that construction?
Under IAS 23, interest costs can be capitalized. If you borrow money specifically for building that mine, those borrowing costs can be added to the cost of the asset,
Okay.
as long as construction is actively underway. Even a portion of general borrowings can be capitalized if they're used to fund qualifying assets like a new mine.
What if they fund this development with borrowings in a foreign currency and there are, exchange rate fluctuations?
Yes. IAS 21 on foreign exchange comes into play there. Generally, exchange gains or losses go straight to the income statement.
Right.
However, there's an exception under IAS 23. If the exchange differences on foreign currency borrowings are seen as an adjustment to interest costs,
An adjustment.
yes, then a portion of those differences can also be capitalized along with the interest. The source gives a UK entity with a US dollar loan example. The insight here is you can't just capitalize the whole exchange difference. You have to look at how much more or less interest you would have paid if you'd borrowed in the functional currency. And that amount, potentially, can be capitalized if it's considered part of the borrowing cost. It adds another layer of complexity, doesn't it?
It really does, funding huge international projects.
Wow. And what about those sales they sometimes make during the testing and commissioning period before the mine is fully operational? Is that considered revenue? This requires careful judgment. According to IAS 16, if that test production is necessary to get the asset ready for its intended use.
Like testing the plant works correctly.
Exactly. Then the proceeds from selling that initial product might be offset against the cost of the asset being built rather than booked as regular revenue. The decision of exactly when the mine is available for use and officially in the production phase involves, engineers, metallurgists, operators, and finance teams all agreeing. It's not just an accounting call.
Right, a joint decision. Okay, so once it is available for use and production is fully underway, that brings its own accounting puzzles. Revenue, inventory, depreciation. Let's start with revenue. How do they figure out when to recognize the income from selling the ore or concentrate?
This hangs heavily on the contractual terms. Things like whether it's a CIF sale, cost insurance freight, or FOB free on board.
CIF versus FOB. Okay.
The core principle from the old IAS 18, before IFRS 15 came along, is about when the risks and rewards of ownership transferred to the customer. The timing of revenue needs to align with when effective control passes.
So even if a contract uses a term like FOB, you still have to dig into the specifics.
Absolutely. If the seller retains significant obligations, maybe they're still responsible for getting the product to a specific port or even the customer site, or arranging insurance after loading revenue recognition might be delayed until those obligations are met.
It's all about substance over form.
Exactly.
What's particularly interesting in this industry, the source mentions, is provisional pricing for certain commodities. The final price isn't set when the product is shipped.
Yes, that's very common, especially for base metals like copper or zinc. The price is often determined days or weeks after delivery based on a future market average.
So how do you book revenue then?
You have to recognize revenue at the point of delivery based on the estimated forward market price at that time. But then, at each reporting date until the price is finalized, that provisional receivable has to be marked to market based on current estimates of that future average price. And any adjustments go straight to revenue.
So your revenue can fluctuate even if production is steady.
Precisely. Just due to commodity price swings impacting these open, provisionally priced contracts, many companies use derivatives to try and hedge this exposure.
Okay. On the cost side, the source talks about depletion and depreciation. What's the standard method for the core mining assets?
The unit of production, or UOP method, is overwhelmingly common.
UOP.
Instead of depreciating over time, You depreciate based on how much of the economically recoverable reserves you've extracted.
Yeah.
So if you've pulled out, say, 10% of the total reserves this year, you depreciate 10% of the mine's cost. The depreciation charge is directly proportional to the depletion of your reserve base.
Does that depreciation base only include the most certain reserves, like proved and probable? Or can it include less certain resources too?
That's a point that requires significant judgment. While proved and probable are the typical base, the source notes that in some specific cases, if management's economic decisions and life-of-mine planning rely on converting measured and indicated resources into reserves, you might include those less certain resources in the depreciation base if it provides a better estimate of the asset's useful life. Consistency in applying this policy is key, though.
So it's not a hard and fast rule.
Definitely not. The example of Entity C, with only 2 years of proven reserves, but a planned 20-year mine life based on resources, really illustrates this complexity.
Stripping costs sound like another unique mining headache. That's the cost of removing overburden, the rock and soil on top to get to the ore, right?
Exactly. And IFRS 20 specifically addresses this for surface mines during the production phase. The key insight is that stripping doesn't just provide access to the ore you're mining today, it can also provide access to ore you'll mine in the future.
Ah, okay. 2 benefits then.
Right. The standard clarifies that costs providing access to current ore go to inventory under IAS 2. But costs that improve access to a future part of the ore body are capitalized as a separate stripping activity asset.
So you can't just lump all stripping costs into the mine's main asset value. You have to separate them out.
No, not according to IFRS 20. You have to identify specific components of the ore body and allocate the stripping costs based on a relevant production measure linked to that component. It moves away from older, simpler methods that might have just expensed everything or allocated it more broadly, kind of ignoring the future access benefit.
Inventory measurement itself seems inherently difficult. You've got huge stockpiles of extracted ore, materials still being processed. How do they count it all?
It truly is an imperfect science. Quantifying stockpiles often relies on physical measurements, using things like weightometers on conveyors, or maybe aerial surveys of the piles. Even with multiple techniques, there's estimation involved. The grade, the concentration of the valuable mineral is determined through lab testing, assays. Using at least 2 independent measurement methods for stockpiles is common good practice to try and get more accuracy.
Right.
And material tied up in the processing plant, what they call ore in circuit, that's estimated based on how much material is fed in and how long it takes to pass through.
What about those low-grade stockpiles? Material you've pulled out, but maybe the price today doesn't make processing them economic. What happens to those costs?
Typically, if the mineral content is currently too low to be economic, the cost of extracting that material is treated as waste removal and expensed.
Okay.
However, if there's a reasonable expectation that future prices or processing improvements will make it economic to process these stockpiles later.
Like holding on to them.
Exactly. Then they could be recognized as an asset, but at the lower of their accumulated cost or net realizable value, NRV.
And determining the NRV for long-term low-grade stockpiles is another judgment call, I guess.
It is. The example of Entity A's coal stockpiles in the source is good here. It shows that NRV should be based on the forecast market price when you actually expect to process and sell that stockpile, potentially years in the future.
Not today's price.
Right. Adjusted for the time value of money, of course. Using today's low spot price wouldn't be appropriate if you don't plan to sell it now. This can introduce volatility into inventory write-downs or write-backs as forecasts change.
Makes sense. What about costs incurred to keep the mine operating, like major overhauls or maintenance?
Costs for significant renewals or reconditioning that restore or provide future economic benefits, like replacing a major piece of infrastructure, can be capitalized under IAS 16.
Okay.
But routine maintenance, everyday repairs, consumables, those are expensed as incurred. The source clarifies you don't accrue for routine maintenance. There's no present obligation until the work is actually done.
Right.
And things like consumable stores and spare parts, particularly significant in remote locations, are treated as inventory, carried at the lower of cost or NRV, requiring write-downs for damage or obsolescence.
The source also briefly mentions accounting for carbon taxes and trading schemes. That seems increasingly relevant.
Yes, very much so. Accounting for emissions trading schemes, ETS, is complex, often requires determining if they fall under existing standards like IAS 12 for income taxes, or maybe IAS 38 for intangible assets, or if they're sort of outside current specific scope and require significant judgment. The source touches on IAS 20, government grants in relation to free allowances received, and IAS 38 for allowances treated as intangibles, though the revaluation model for these isn't commonly used in practice. It's definitely an evolving area.
Okay. Moving on, mining often involves partnerships, right? Given the scale and risk.
Cooperative arrangements are very common, yes. Determining exactly what kind of arrangement you have is crucial, especially with the introduction of IFRS 10, 11, and 12 around 21/3/2014.
So how do you figure out if buying into something is a business combination, like buying a whole company or just buying a specific asset?
IFRS 3 looks beyond just the legal structure. It asks, are you acquiring a set of inputs and processes that together have the ability to create outputs?
Inputs, processes, outputs.
Right. The source provides examples where this is a judgment call. Is a portfolio of exploration properties a business, even if it has no employees or revenue yet? Well, if there's an active exploration program, that's the process that can turn the land and permits the inputs into a valuable deposit, the output. It might be considered a business.
Okay. And if it is a business combination, how do you value what you've acquired?
IFRS 3 requires a purchase price allocation. You have to identify and value all the assets and liabilities acquired at their fair value on the acquisition date. This includes things the acquired company might not have recognized on their books, like, say, unproven mineral reserves or maybe contingent liabilities.
Right.
Anything you paid above the fair value of these identifiable net assets is recorded as goodwill.
Goodwill, representing synergies or market access, perhaps.
Exactly. Things like expected synergies, market access, other intangible benefits. What's interesting, as the source points out, is the concept of a bargain purchase.
A bargain purchase. Sounds good.
It means if, after this detailed fair value exercise, the price you paid is less than the fair value of the identifiable net assets, that difference is immediately recognized as a gain in the income statement.
Straight to profit. Wow.
After double-checking the values, yes.
The source also mentions deferred tax impacts in these deals, sometimes mechanically creating goodwill.
Yes. Recognizing acquired assets and liabilities at fair value often creates temporary differences between their accounting value and their tax base. Under IAS 12, you generally recognize deferred tax on these differences, which can impact the goodwill calculation. Acquired tax losses can also be recognized as an asset if it's probable they'll be used against future taxable profits. And acquirers get a measurement period, typically up to 12 months, to refine these fair value estimates.
Okay, so that's buying a whole business. But joint arrangements, where companies partner on a specific project, are structured differently. What was the big change with IFRS 11?
The major shift with IFRS 11 was classifying arrangements based on the parties' rights and obligations regarding the assets and liabilities of the arrangement.
Not just the legal form.
Exactly, not just the legal form. It splits arrangements into joint ventures, JVs, and joint operations, JOs. In a JO, you have direct rights to the assets and obligations for the liabilities of the arrangement. In a JV, you have rights to the net assets, kind of like an equity interest.
So something legally called a joint venture might actually be accounted for as a joint operation under IFRS.
Precisely. The source gives an example of an arrangement in a separate vehicle where the parties are obligated to take all the output, even if that output is readily saleable like gold. If you are taking substantially all the economic benefits derived from the assets and are exposed to the risks related to those assets, it's likely a joint operation.
Okay. And the accounting for JVs specifically changed, right? No more proportionate consolidation.
That's right. IFRS 11 eliminated the option to use proportionate consolidation for joint ventures. Now, JVs must be accounted for using the equity method under IAS 28.
The source also delves into complex deals like farm-out agreements. What exactly is a farm-out?
A farm-out is where one company, the farmer, gives another company, the farmee, an interest in a mineral property. In return, the farmee agrees to perform exploration or development work on the property, often covering the cost for both their acquired interest and the farmer's retained interest.
So the original owner gets work done for free, basically, in exchange for giving up a piece.
In essence, yes. And how the original owner or the farmer accounts for this is notoriously tricky, especially for properties still in the E&E phase, because IFRS doesn't have specific guidance on it.
Ah, a gray area.
Very much so. The source highlights how different approaches have developed in practice. It outlines 3 possibilities for the farmer company N in their example. One approach, noted as common industry practice, is to only recognize any cash received and keep the cost of the retained interest on the books at its original value, less that cash. sort of a cost recovery approach.
Okay.
Another is to recognize the cash and an asset for the value of the future work the farmer commits to at the time of the agreement, booking a gain immediately. But this can create a lot of income volatility.
Right, based on estimated future work.
Yeah. A third approach is to recognize the cash now and only recognize the value of the future asset, the work done, later when it's actually completed and received. This avoids the upfront volatility of the second method.
And the farmie, the one doing the work.
Their accounting is clearer. They simply capitalize the costs they incur as they perform the work according to their own accounting policies for exploration or development, and they need to disclose their contractual obligations to perform this work.
The source notes that the specific structure in their company N, P, our example, where the parties share output, meets the definition of a joint operation under IFRS 11. How do parties account for their stake in a JO?
Instead of just showing one line item for investment in joint venture under equity accounting,
Right.
each party in a joint operation recognizes its own assets it controls, its own liabilities it incurs, and its share of the revenue and expenses from the operation, line by line on their own financials.
Much more detail then.
A much more detailed view on the balance sheet and income statement compared to equity accounting, yes.
And the transition to IFRS 11 must have meant companies had to reclassify some arrangements and potentially make big balance sheet adjustments.
Absolutely. An arrangement that was previously equity accounted might suddenly require you to recognize your direct share of all the underlying assets and liabilities. Not always a simple exercise.
A significant, unavoidable cost in mining is the requirement to clean up the site once operations stop.
Yeah.
How are these closure and rehabilitation obligations accounted for?
Well, when a mining company creates a disturbance on the land, which happens during development and continues throughout production, they incur an obligation, legal or constructive, to rehabilitate that disturbed area.
Okay.
IFRS requires that a provision, a liability, is recognized for this future obligation. This provision is measured at the present value of the estimated future costs to perform the rehabilitation.
Present value. So the liability on their books for cleanup grows over time.
Yes, it grows for two main reasons. First, as more land is disturbed during ongoing operations, the estimated total cost of rehabilitation increases. Second, because the liability is measured at present value, there's an unwinding of the discount each period as you get closer to the future cleanup date.
Ah, the time value of money effect.
Exactly. This unwinding is recognized as a finance expense in the income statement. Changes in the estimated costs, the expected timing of closure, or the discount rate also adjust both the provision and the carrying amount of the related mining asset.
What if they've set aside money in a separate fund specifically for this cleanup? Does that offset the liability?
Good question. IFRS 5 provides guidance here. Any interest the company has in a separately administered decommissioning fund must be recognized as a separate asset on the balance sheet.
Separately.
Crucially, yes. You cannot simply net this fund asset against the closure liability. They must be shown separately, giving users a clear view of both the obligation and any dedicated funds available to meet it.
Okay. Given the volatile nature of commodity markets and the sheer scale of mining assets, checking the value of those assets for impairment must be absolutely critical.
Oh, definitely. Mining assets are reviewed for impairment whenever there are indicators that their carrying value might not be recoverable from future operations. And goodwill acquired in business combinations, as we discussed, must be tested annually regardless of indicators.
What kind of red flags signal that a mine might be impaired?
Both external and internal factors. Externally, the most obvious are significant decreases in commodity prices, like the source mentioning a decline in the spot price of copper for a copper mine. That's a clear indicator.
Made sense.
Also, changes in government regulations, taxes, or environmental rules that negatively impact future cash flows are key indicators. Internally, things like significant cost overruns on development, unexpected operational problems, maybe physical damage to the asset, or a strategic decision to restructure or put a mine on care and maintenance could all trigger an impairment test.
And the impairment test itself compares the asset's carrying amount to its recoverable amount. What's that?
That recoverable amount is the higher of two values. Fair value, less costs to sell, FELCTS, and value in use, VIU.
Okay, let's break that down simply. How do they figure out those two values for something complex like a mine?
Okay, think of FELCTS as what a hypothetical market participant would pay for the asset today minus the cost to sell it. This is often calculated using discounted cash flows based on market assumptions, typically using a post-tax discount rate reflecting the market's view.
Right, a market perspective. And value in use.
VIU, on the other hand, is based on what your company specifically expects to get out of the asset by using it. It's calculated using discounted cash flows based on your internal budgets and forecasts, using a pre-tax discount rate reflecting your company's specific cost of capital for that asset.
Pre-tax. The source notes that calculating that pre-tax rate for VIU can be mathematically tricky.
It can be, yes.
Right.
Which is one reason the source notes FELCTS can sometimes feel more intuitive or easier to work with for management. A key point is that both calculations need to factor in cash flows related to closure and rehabilitation if those costs are included in the asset's carrying amount for impairment testing purposes.
And assets aren't always tested individually, right? They group them into cash-generating units, CGUs.
Correct. A CGU is the smallest group of assets that generates cash inflows that are largely independent of cash inflows from other assets or groups of assets. The source gives an example. A smelter connected to a mine might be a separate CGU if it could process ore from other sources and generate independent cash flows. Defining CGUs requires judgment based on how the business is managed.
And shared assets, like a port.
Exactly. You have to be careful how you allocate shared assets, like a port facility used by multiple mines, when testing those mines for impairment.
How does goodwill fit into this impairment testing?
Goodwill can't generate cash flows on its own, so it's allocated to the CGUs or groups of CGUs that are expected to benefit from the business combination where it arose. When testing for impairment, if a CGU that holds allocated goodwill shows indicators of impairment, you first test the CGU excluding the goodwill. Then, you test the CGU including the goodwill.
Okay.
If the group including goodwill is impaired, the impairment loss is allocated first to reduce goodwill to zero before being applied proportionally to other assets in the CGU.
Got it. Moving from operations to the financial results, mining taxes are a complex area. The source stresses distinguishing between income taxes and royalty or production taxes. Why is that so vital?
Because income taxes, which are calculated on profit, fall squarely under IAS 12 and require deferred tax accounting. You calculate temporary differences and recognize deferred tax liabilities or assets. Royalty or production taxes, however, are typically calculated on sales revenue or volume produced, not profit. These are generally treated as operating expenses or deductions from revenue. And critically, they do not give rise to deferred tax balances because they fall outside the scope of IAS 12.
So different tax treatment entirely.
Completely. And this distinction can be very subjective depending on the tax legislation in a specific country. Is this tax really based on profit or on something else? Significant judgment involved. The source also mentions that you absolutely cannot simply smooth the estimated total tax charge over the life of the mine. You have to account for it period by period based on the specific tax rules.
Which can lead to lumpiness in the income statement.
Exactly.
What about deferred tax in general beyond the royalty issue? The basics.
Deferred tax is calculated based on temporary differences. These are the differences between the carrying amount of an asset or liability on the balance sheet, its accounting value, and its tax base, the amount attributable to it for tax purposes. You multiply these differences by the tax rates expected to apply when the asset or liability is recovered or settled to get the deferred tax amount.
The initial recognition exemption, or IRE, in IAS 12 sounds particularly relevant in the mining context, according to the source.
Yes, the IRE is mandatory, not optional. It means you don't recognize deferred tax on temporary differences that arise from transactions that were not a business combination and, when they initially occurred, affected neither accounting profit nor taxable profit.
Okay.
This often comes up when acquiring interests in joint operations or jointly controlled entities that don't meet the definition of a business. Applying the IRE can lead to differences between the accounting and tax treatment of assets acquired in these non-business combination deals without a corresponding deferred tax asset or liability being recognized initially. It's a quirky but important part of IAS 12.
Mining is a truly global industry. Companies operate across borders and often deal in U.S. dollars, that being a major commodity trading currency. But that doesn't automatically mean the U.S. dollar is their functional currency, does it?
Absolutely not. Determining the functional currency, the currency of the primary economic environment in which an entity operates, requires careful analysis under IAS 21. While sales might be denominated in U.S. dollars, you have to look at factors like the currency that primarily influences sales prices and, crucially, the currency of the company's costs.
Labor, materials.
Exactly. Labor, materials, local services. Also important are the currency of financing activities and the local regulatory and economic environment. Often, the local currency of the country where the mine is located ends up being the functional currency, even if commodity sales are priced in USD. The dollar denomination might just be a pricing convention, not reflect the underlying economic environment.
So a multinational mining group could have many different functional currencies across its various operations.
Precisely. Each entity needs its own assessment. And you only change your functional currency if there's a significant change in the underlying economic facts and conditions. It's not something you switch frequently.
Right.
Any change is accounted for prospectively, not retrospectively. An entity's functional currency could potentially change, for example, as it transitions from being purely an exploration company to a production company if the dominant economic factors change.
Okay. Beyond outright ownership, mining companies often use assets through various arrangements. The source touches on how some of these might actually be leases under IFRS, even if not called that.
That's correct. IFRIC 4 provided guidance on this, now superseded by IFRS 16 principles, but the concept is similar. It helps determine if an arrangement contains a lease. The key is whether the arrangement gives the right to use a specific asset and whether the entity has the right to control the use of that asset.
What does control the use mean in this context?
It means having the right to obtain substantially all the economic benefits from the asset's use and the right to direct how the asset is used. So things like long-term service agreements, throughput arrangements where you have guaranteed access to capacity, or tolling arrangements where you essentially direct the use of a processing plant.
These could be leases.
They could contain embedded leases that need to be accounted for as such. If it's a finance lease, under old IAS 17 or now meets IFRS 16 criteria, the asset is recognized on the lessee's balance sheet with a corresponding lease liability. If it's an operating lease under IAS 17, it's stayed off balance sheet for the lessee.
Right, big difference. Okay, when reporting performance, how do these global multi-product companies decide how to present their information? Segment reporting.
They use the management approach for operating segments under IFRS 8.
Which means they report segments based on how management internally views and runs the business?
Exactly. It's based on the information reviewed by the chief operating decision-maker, often the CEO, or a group of senior executives. This structure gives external users insight into the business from the same perspective as internal management. Companies can aggregate segments with similar economic characteristics, if it makes sense, but they have quantitative thresholds to meet.
Quantitative thresholds?
Yes. Reportable segments must meet certain size criteria, 10% of revenue, profit, loss, or assets. And the reportable segments collectively must cover at least 75% of the entity's total revenue. Examples from the source, like Tech Resources segmenting by product type, or First Quantum Minerals by individual mines, show the variety of valid approaches depending on how the CUDM views the business.
Financial instruments, especially commodity contracts, are absolutely central to managing risk in mining. How are these accounted for under IFRS? The source seems to focus on the older standard, IAS 39.
Yes, the source relies on IAS 39, as IFRS 9 wasn't fully implemented at the time it was written. Under IAS 39, contracts to buy or sell non-financial items like commodities are generally outside its scope.
Generally outside.
Unless they can be net settled or are readily convertible to cash.
Let's simplify that net settled idea. What does that mean?
Think of it this way. Can you settle the contract without actually delivering or receiving the physical commodity? Maybe by paying the difference in price.
Oh, yeah.
The source includes the decision tree. If you can net settle, or if the commodity is so liquid it's like settling with CAC, that it falls under IAS 39 and is treated as a derivative, measured at fair value through profit or loss, FVTPL.
Okay, treated as a derivative. But there's an exception.
Yes, a crucial one, the own use exemption.
Own use.
If you enter into a contract solely for your expected production, sales, or usage needs, you intend to physically deliver or take delivery, you don't have a history of net settling similar contracts, and you have the capacity to do so, then it is outside IAS 39 scope, even if net settlement is permitted by the contract.
So it's about your intention and practice.
Exactly. It's not an optional election. If you meet the criteria, you must apply it. The example of Entity A with a fixed price forward to sell copper illustrates where own use would likely apply. The key insight is that even if a contract looks like a financial instrument, if it's tied directly to your core operational needs, it might be treated differently. Written options, however, can't qualify for own use.
But some long-term contracts might not qualify for own use.
That's right. If they don't meet all the criteria, perhaps because the company does have a practice of net settling, then they're treated as derivatives under IAS 39 and measured at fair value through profit or loss. This can be tricky for long-term deals where market prices aren't readily available for the entire contract term.
And embedded derivatives, that sounds complicated.
They are common. Imagine a coal contract where the price is linked to the price of oil. The oil price link is an embedded derivative. If it significantly changes the cash flows of the contract and isn't closely related to the core contract selling coal in this case, it might have to be separated from the main contract and accounted for separately as a derivative at fair value under IAS 39.
Okay. You have to assess that relationship.
Yes, when you first enter the contract or if there's a reassessment event.
Hedge accounting seems like a critical tool for managing all that price risk.
It absolutely is. Using cash flow hedges for highly probable future transactions, like a forecast future sale of gold or copper, allows companies to smooth out earnings volatility. The gains or losses on the hedging instrument, like a derivative, are initially recognized in equity and then recycled to profit or loss when the hedge transaction occurs, offsetting the price movement on the actual sale.
But the forecast has to be highly probable.
Yes. If that forecast transaction is no longer highly probable, the hedge relationship ends, and amounts accumulated in equity are recycled to profit or loss immediately. The source noted that IASB was looking at potentially simplifying hedge accounting criteria under its project, which eventually led to parts of IFRS 9, which would be a big deal for the industry, potentially allowing more risks to be hedged effectively.
And finally, on financials, IFRS 7 requires extensive disclosures.
Yes, IFRS 7 pushes companies to explain how they view and manage risks like liquidity risk and market risk, including the significant commodity price risk they face. It focuses on providing insight from management's perspective on these risks.
The document also briefly mentions a couple other areas, share-based payments, particularly in the context of empowerment transactions.
Yes, IFRS 2 applies here. In situations like BEP, Black Economic Empowerment transactions in South Africa, where shares might be issued to a party at below fair value, IFRS 2 requires the difference between the fair value of the shares and any cash received to be expensed. This expense represents the benefit received by the company, whether it's identifiable goods or services, or a less tangible benefit like securing a mining license or meeting regulatory requirements. The example of Entity A awarding shares for a license shows expensing this value difference as an unidentifiable benefit related to securing that license.
And finally, the source highlighted some key challenges when companies first transitioned to IFRS 1, the first-time adoption standard.
Yes, transitioning to IFRS for the first time often requires significant adjustments, particularly in areas like E&E costs and stripping costs, which might have been accounted for very differently under previous local GAAP. These adjustments can have a major impact on reported assets and equity on adoption.
Wow, that really was a comprehensive journey through the financial underpinnings of the mining world. We started with finding the ore, went through building the mine, selling the product, dealing with complex partnerships,
Planning for cleanup.
managing volatility and risk, and even touched on things like taxes and empowerment deals.
It truly highlights how applying a principles-based framework like IFRS to an industry with such unique operational realities requires immense judgment, detailed analysis, and really deep industry knowledge. It's far from a simple tick-box exercise.
And using those specific examples from the source document, like Entity A or the farm-out scenarios, really helps illustrate where that judgment comes into play, doesn't it? You can see why understanding mining finance means getting into these very specific issues.
Absolutely. The need for clear, comparable financial reporting in this truly global industry remains paramount for investors and other stakeholders trying to make sense of these complex operations.
So what does this all mean for you thinking about this industry today? The source document, remember, was written years ago. It even mentioned that the global standard setters, the ISB, were considering adding extractive activities to their active agenda.
Right, to provide more specific guidance.
Exactly, and improve comparability internationally. That project never fully materialized into a comprehensive, standalone standard for mining. Given how much the mining industry, the technology used, and global demands, including environmental and social expectations, have changed since that publication.
A lot has changed.
What further complexities and potential accounting developments might need to be considered now to truly achieve that goal of international comparability in mining finance? Is the current framework still sufficient, or are there gaps? That's something to ponder as you look at financial reports from mining companies. Thanks for joining us for this deep dive.